Welcome back to our channel. In this video, I talk about the phenomenon of customer concentration, a condition in which one or two customers can make or break your business. If one customer accounts for a big chunk of your revenue, 20, 30, 40% or more, your business is worth a lot less than what you think it is. In fact, it may be worth nothing to many buyers. Let me explain. Customer concentration happens when one or two clients represent a disproportionately large share of your business's revenue. In our network, we define disproportionately large share as anything above 25%, and in some cases, as little as 20%. Admittedly, to the business owner, this feels great when they're running the business. It's proficient, it's predictable, it's efficient, and it's usually high margin. But to a buyer, it feels like they're standing on the edge of a cliff, and there's a big red sign flashing, danger ahead. Now, why is that? Because when one customer becomes the customer, the business is no longer the business. It's a dependency. Buyers look at it this way. If that customer leaves the day after I buy this business, what do I have? What have I really bought? This concern is an expression of perceived risk, and risk is factored into value. The higher the perceived risk, the lower the value. Here's the impact that such risk can have on a business's value. If one customer represents 20% of the revenue, there's going to be a discount to value applied by any sentient buyer. If that customer represents 30 or 40% of that revenue, that risk discount is going to be significant. If the customer represents 50%, your business is probably unfinanceable. No lender's going to look at it. And if your business represents 70 to 80% of your revenue, your business could be unsellable unless you're willing to practically give it away. Lenders hate it. Private equity hates it. Strategic buyers may tolerate it, but they'll use that level of risk to crush the price they'll pay for it. Now, here's an example of what that kind of risk can do to a business's value. Let's say that your business has the following characteristics: $2 million in revenue, $500,000 in discretionary earnings, a valuation multiple for your industry, adjusted for all the variables that apply to your business, of 3 times earnings. This suggests that you would have an expected value for your business of $1.5 million. But one customer is responsible for 45% of revenue. You will not get a 3 times multiple. You might get a 1.5 times multiple or less, meaning that your $1.5 million business is suddenly an $800,000 business or worse. And while most buyers will discover this problem during the due diligence period, I've seen deals collapse even if the buyer goes forward at the closing table when the lender discovers the high concentration of revenue in 1 or 2 clients. Now, can you fix this? Well, yes, you can fix customer concentration, but you have to act early enough. There are several things you can do to reduce that concentration and thus reduce risk. You can diversify into new customer segments, broaden your customer base. Now, this makes sense. The more customers you have and the revenue you generate, the lower the percentage of your really high purchasing customers. You can break large accounts into multiple smaller contracts. Contracts are the key. If you develop multiple contracts from one large account, and those contracts have varying expiration dates, you reduce the perceived risk that a buyer will have that all of that revenue will disappear on day 1 if a client leaves. You can develop a recurring revenue model. This is in high demand right now. You can build stickier customer relationships using longer contracts, service bundles, making it less likely that your customer will leave. And here's the big one. Extend the contracts with your existing big customers before you come to market. A contract with your biggest customer that expires in 6 months represents huge risk and reduces value significantly. But a contract with 2 years remaining with that same client significantly reduces that risk and increases the value. Buyers pay for predictability. You can create predictability through diversification and applying the steps I have mentioned above. So here's the bottom line. Customer concentration doesn't just scare buyers. It destroys business value and may even make your business unfinanceable. But with planning and time, you can change the math dramatically in your favor. If you know you have a concentration problem, deal with it now. It can literally make hundreds of thousands of dollars of difference when it comes time for you to sell. Now, in our next video, we'll discuss the inverse of customer concentration, owner concentration, and how that can render your business unsellable. There's going to be a case study from a recent example in our files. So subscribe so you don't miss that one or any of our future weekly videos. I've added links to multiple resources on valuing and selling business in the description below. And if you have any questions, leave a comment. I'll respond to them all. Now, if you found this video helpful, give us some love. Hit the like button and don't forget to subscribe. In the meantime, I'll see you in the next video.